Hey everyone, hope you're having a good day. My name is Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my opinions, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive right in, take a look, see what people are sharing. If you want to follow me, it's at @Finance. And if you want to join our community, finding-value.com, where I dive deeper into all of these topics, looking for potential investment opportunities and sharing them with everyone in the community. I also do a lot of diving through earnings conference calls, technical analysis. I am a long-term investor. I don't trade the short term. I don't try to necessarily time the market using buy and sell points with just technical analysis. I look for a confluence of information. Think of it as a hybrid investor where you're looking at the fundamentals and the how cheap a company is, and then you also want to align that with ratios of the sector. You could even do ratios with the company, and then you can also do technical analysis priced in dollars and all that stuff. So I'm looking for an alignment between all of it, which increases the probability of success. That's what I've seen. If that sounds interesting and you want to learn all that, special is the coupon code that we've got. You can get 50% off the first month only, and you get a larger discount on the yearly membership if you want to swap over from a monthly to a yearly. So we're going to start with Dividend Koala. He says, how do we define a bull market? Spot uranium's down 40%. And then he goes along and lists off all of these individual companies and some ETFs and how much they are down. A bull market actually has these large pullbacks in it. My response is we are in a secular bull market in uranium with a cyclical, with a C, pullback. And you can look at some of these using URA as an example. This is URA. In my opinion, this is a double bottom. The breakout of the double bottom, we squeezed into the corner here. A is the breakout. B is your ideal entry point for a lot of the technical analysis guys. And then we've made a higher high, so to speak, up here. And we have a higher low. And that is, by definition, a bull market, a market that moves higher highs and higher lows. What people, I think, don't understand is that uranium has gigantic moves. From peak to bottom, these things are big. And I think people struggle with the volatility. Somebody said to me, oh, I don't want this one, hold on. I want the price range. So this pullback here from top to bottom, it's 44.24% on an ETF. And more recently, if we put it to this top, we've had a pullback of roughly about 32%, pulling back to that bottom there that we had recently. And what you see on Twitter is you see the sentiment goes from euphoric to everyone yelling at people. I don't know why. It's like it's very trashy to see this. I I would expect the uranium community to have more composure than what it does. But I guess we've got a lot of retail investors in here that just like to yell at people. I don't know why. So even if it's from here to here, I'm seeing that all the yelling and all of the discouragement. I start to see posts like, how do we define a bull market? And then a lot of people being really pissed off. Um, that's your sentiment going back and forth. And you can use that. Like, this is probably a good time to buy when all the retail people are yelling at each other and they're selling. They all shut up when it goes up, and then they all get pissed off and start being really mouthy when it goes down. But what I would do and my approach, I purchased it here a whole bunch. I purchased it in this general area here. On the website, we also purchased it in this general location. We've come on up. We didn't really purchase much up here. But again, I think we're going to enter an area here that I like. I would enter again. And I know I'm sharing this with everyone here, but if you're interested in the companies that I have, you can look at them. And I think now is a good time to be looking because when we get another leg higher, all the retail people who are yelling at each other they're going to probably buy in, but they're probably going to buy in at some higher level. So again, this is a game against you versus yourself. The game is to get in, and uranium's really it's kind of slow. You get a lot of consolidation, like this consolidation is pretty big. We had another pretty big consolidation, um, and when the market does turn, I think we're going to see a very big move. And right now, there's a lot of companies that are really cheap that you can get that no one cares about. Like they do, no one's looking at this stuff right now. Everybody hates it. And there's small little companies. They're very risky. I'm not going to say they're not risky, but they're good to hold on to if you're very patient. If you can watch paint dry, then you're good. If you are swiping left, swiping right, and you have to look at your phone every 2 seconds, it may not be right for you. But that's what's going to be required to be a very big winner is to size up this big move that's coming, and I think it's going to end up somewhere way up here or more. We may even beat last bull market and beat that. Who knows? And I know there's maybe some dilution in some of the companies, but it depends where the price of uranium goes to. Chamath says the big gobs of money in the world are speaking pretty loudly right now. The U.S. market is safe, and our money will be there. If UK and Europe want to support an ongoing conflict between Ukraine and Russia, they can borrow from us to do so. Blah blah blah. But look at this: Germany 10-year up 8.51% in a day. Their yields up 8.5%. France's yields up 4.3, UK's up 1.1, Spain's up 4.3, and Italy's up 3.6. As these go up more than the dollar, that could cause their currencies to go up with it. And the dollar could go down. And this is all relative. But I saw these yields and the percentages that they were going up just today, and I'm like, oh my God. There's down below, there's a chart of the German 10-year, so we can go over that in a little bit. Shabam says global conventional discoveries at an alarmingly low rate as exploration capital remains subdued. And even if the capital came in, I don't think they're going to find much. Unconventional oil, the supply demand gap since 2012 and is now flatlined, and legacy conventional declines equals spare capacity needs to be pulled at a faster pace than expected. So this is conventional discovery since 1900. I look at this chart and what I see is a big peak in about 1963, 4, 5. It rolled over and we've been in decline ever since. And this is your decline in annual well count. This is volume discovered in barrels of oil equivalent. It looks like billion barrels of oil equivalent. And we are producing more oil than what we are finding. We are producing more oil than what we are finding. We are producing, I think this is right, 3 to 4 barrels of oil for every barrel that we are finding today. At some point, this is going to catch up and we will peak in oil production. The big question is supply going to be the constraint or is demand going to peak first before the supply? That I do not know. But if I were to guess, I think supply is going to peak before demand. Oil is found in everything. It is highly correlated to GDP. And if it does peak, we are going to see an absolute moonshot in gold and silver because money and bond markets are going to come into question. This here is a function of GDP having problems and them trying to keep their currency system and bond markets alive. If this bond market and their economies hit a decline in energy, that's your problem. And that's exactly what has occurred in Europe. They have very expensive energy prices, and it's absolutely grenading their bond market. And what's going to happen is people are going to run to what is safe. If people can't run to the bond markets, and essentially the stock market is an extension of yields, you could see stocks and bonds crash together and money rotate into commodities and precious metals. So I think if we see a problem in oil, oil is going to spike, and you're going to see problems in currencies and bond markets. And when you start to see problems there, people are going to run at what is safe. And what is safe is gold and silver. That's what we saw in the 1970s. It's the same setup, except this time the entire world is doing it. Last time it was just America. So we're going to see gold like it would launch under that scenario, and people are trying to position before that occurs. I think countries know this, and they're already trying to position for it. Here's Eric. He says, panic is palatable with technical indicators reaching the most oversold levels since COVID, and 25 energy stocks making 52-week lows yesterday on almost 2 times normal volume. Energy stocks, especially in Canada, are clearly for sale, and valuation dividends have now approached levels that have typically offered support, 12% plus free cash flow yields and 5-9% sustainable dividend yields. Why is sentiment so terrible? Enormous volatility and enormous uncertainty. I'm not going to go completely over all this. There's a lot here. But what I wanted to show you was the global observable oil inventories, onshore and oil on water. It is still incredibly low. Now, that doesn't mean that oil can't go lower. What that means is that your inventories are low, and a lot of the times there's a correlation between the price of oil and inventory levels of the commercial inventory. This one here is your global observable oil inventories. Oil should not be as low as it is. It should be higher. And that's what OPEC was trying to do. But they're also fighting the paper barrels. The oil market is leveraged in the paper market 30, 40 to 1. So they're trying to fight that, but right now they are losing. But I'm sure they see an increase in demand coming up this summer, and they're going to bring back barrels because of the demand, and they don't want the market to get too expensive. So yes, oil is cheap right now, and it's in 60 something dollars a barrel, but that could change rapidly depending on what inventories do. Dollar lower, hard assets higher. Completely agree, 100% with this statement. We are at a key turning point in history, and a global rebalancing is now unfolding in his view. And I shared this again. Commodities to equities ratio versus the US dollar. And maybe he got this from me, but here's your commodity bull markets with a weakening dollar. The dollar starts to weaken, and then your commodities start to take off, which are priced in dollars. You also start to see money flows away from dollar-denominated assets towards emerging markets and other areas who are also very commodity heavy. So the big rotation is coming. The dollar is a piece of it. And you can also look at all those other capital rotation charts where you price commodities versus like the NASDAQ or oil to NASDAQ ratio or gold to NASDAQ or S&P 500. They all say the same thing. Now, that is called confluence. Confluence is the merging of information to come to a conclusion. This is more information of that conclusion. A very expensive dollar, which means all of these people, investors, piled into the United States dollar denominated assets, which drove the dollar up. This will reverse at some point, and you're going to get commodities to bottom and turn up. One of the things that I think everyone should be aware of is that we are at a ratio that is far lower than any time in history. We are, in fact, at all-time lows, going back hundreds of years. What that means is that all of the money has piled into financial assets, and not nearly the amount of money has stayed in commodities in relationship to history. So we've got the largest imbalance between financial assets versus hard assets. That also had an impact on the DXY going up. This was also spurred because it just keeps adding more and more information to this. What drove that was interest rates. We went from a peak of interest rates in 1981, and we drove it all the way down to basically zero in 2020 and 2021. That was the bottom of this financial market being driven by interest rates going to that level. Interest rates have broken out of that 40-year downtrend movement. We can look at it here. We'll pull up the US 10-year yield. So we've broken out of this downtrend here, and now we're in an uptrend, moving upwards. This has substantial ramifications for the valuation of assets if this continues to go up. So again, it's the cycle here of bottoming, peaking, and then bottoming. And this is your longer cycle. And I don't think people understand the ramifications of interest rates and the pricing that these interest rates have on assets. When this goes up, it's going to eventually hit the stock market. What this does, and I'll just try to explain it very easily. This area here, when interest rates are really low, since nobody can get returns in bonds in this bottom here, everyone piles into stocks because they get no return down here in terms of yields. Since they're getting no return, everyone piled into stocks at the top here. Now, as bonds start to go higher, money's going to say, well, I don't want to be in these overvalued stocks. I can go buy a bond for 5% or 6% or 7% or whatever it goes to. Money's going to start to unwind out of the stock market. And that's where you get those big, long consolidation sideways periods in the markets here. These are these kind of consolidations where the market's overvalued and it sells off and consolidates in these three hump consolidations there. It's in every single one. And it just repeats over and over. That is your cycle. It's your longer cycle here where stocks go down, they go up, they go down, they go up, they go down, they go up, and that's your cycle. And it's driven by certain things, and I can go into it, but it's going to be too long. So coming on down, it says, I'm not sure I can handle kangaroo market bros. So we've got a bull market that goes up, a bear market that goes down, and then kangaroos are just jumping all over the place. I thought that was good. HFI Research says China finally starting to drop the gauntlet on fiscal stimulus. Copper is reacting. Copper to gold ratio is starting to turn higher, and oil is selling off. I think, so we could do a copper to gold ratio here. This is the copper to gold ratio over time. We can maybe make it in candles there. And we're at a pretty low level compared to history. And it's starting to turn higher here. Now, is it gonna turn and go on up? I don't know. We'll see. We could also put maybe crude oil overlaid on top of this and see if there's any sort of patterns here. And it sure looks to me that this is highly correlated, that the oil price and copper to gold ratio are correlated. Peak, and then you've got the three hump consolidation there coming on down. Boom, 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 and then we've got a move higher. And again, if we zoom in on the right-hand side, maybe we've got a potential. Let me draw this just a little bit different here. So we've got this, and then we've got maybe, I'm going to draw it like this, with a false breakdown to the downside. So this being a false breakdown. And then it could slingshot to the upside where copper starts to outperform gold, and then we could also see oil go up with it. So they're basically copper is so the reason I use this ratio, people say, well, why does it matter? Well, when the ratio goes up, it means copper, which is this first one, is outperforming gold, which is a certain market condition. The economy is coming back, whether it's China's economy or American economy, whoever consumes commodities. Gold is a fear trade. It's a safe haven asset. So this is safe haven as gold outperforms copper in 2008. And you could say that maybe gold doesn't go down as much and copper just, falls like off a cliff. And that's what we see. And we had a move higher from March 2020, April 2020 upward. And copper moved before oil did. So if this moves all the way up and starts to move, that is another indication that we have the economy trying to turn higher, whether that's stimulus in China or whatever, it doesn't matter. People are positioning in it, and we could get another big bull market. And I think oil will follow slightly behind it. That's why it's important. Here's North Star. German 10-year government bond yields breaking out again. Is a debt crisis coming? I don't know, but this looks like it's ready to rip to the upside. Now, this chart here, it's the same chart that I drew on the American interest rates, the 10-year on the interest rates. So the US 10-year on the short term, it has the same pattern that all the other ones have. So it's the same setup, I think, as this, and I think rates are going to go up. There's your the way this thing looks. You've got your three hump consolidation. Sometimes it breaks on up. Looks like we got a retest going on there, and we're going to break higher. So that's what I see. And if we break higher, I mean, crude oil is more or less just an extension of interest rates. So crude oil generally leads interest rates to some degree, and we can see we peaked here, and we peaked here, and then I think oil is going to take off again. It's all interconnected. And copper is another reason why I think oil could eventually move on up here at some point. Covey says if we crash the U.S. economy, we can get tens to trade at 4.2% instead of 4.5%. That's Scott Bessent. He's the Treasury Secretary of Treasury. Yeah. Morgan Housel says buy good companies, don't pay a lot for them, hold them for a long time. Keep it simple. That's it. Buy good companies, don't pay a lot for them, hold them for a long time. Ross Healy on BNN says no drill baby drill under $85, $90 a barrel. Not going to happen. Not going to happen, boys. EIA inventory 3.5, crude's up 3.6 million. Gasoline distillates are down 2.7 if you add them together. So a little bit of a crude build. We're in the springtime. We're supposed to be building now, and we haven't really been building very much. Here's some information here on recency bias. It says Gary says it's incredibly hard for most people to break recency bias. Most traders assume that since silver hasn't done much in the last 14 years, that it means it will never do anything. I heard the same thing about gold last year. It has been stuck in a 13-year cup and handle base, and 3 years into the handle, traders were convinced it would never move. Then it would break out in March of last year. Remember, this was when I was trying to convince people the suppression of the gold market had collapsed. And what followed was an 800-point short squeeze rally. The same thing is going to happen with silver. When the suppression breaks, silver is going to produce a violent short squeeze rally. In my opinion, the battle for control of the silver market is being fought at the $33 line in the sand. Silver is going to make its second run at that zone either this week or next, and I think it will break through this time. I don't think the banking cartel will be able to hold the line any longer, so you can remain stuck in the past and miss another big opportunity, or you can learn from the past and prepare now. I've been prepared for it since 2018, guys. I bought a whole bunch physical. I'm in the mining companies. What people lack, here's the thing that I see that people lack. They lack a strategy, they lack vision, and then they lack the ability to hold on because they don't have a strategy. So what I've done is I just hold crap. And when I see these big patterns develop, and I saw the pattern develop even before 2018 in silver, and we're kind of almost here. I started buying it what I thought was the cheapest price. In 2018, silver was 14, 15 bucks with really low premiums. Like you could buy whatever you want. Nobody gave a crap about it. I mean, you could buy American Eagles. They were all over the place. No one cared. Super low premiums. Sometimes they'd go on special for like $1.50, $1.99 over spot. And then you could just load them. You could load up whatever you want. And here we are now, and I don't like the prediction thing. I just go after what's cheap, and if it's going to break and hit here, perfect. I'll make a bunch of money, and my life will probably be the same. I mean, I'll just have more money, I guess. But like this is an opportunity, and there's a ton of recency bias amongst everybody. I was buying platinum 2019, 2020. That bottom, I got real active at 2020, 2021. The ratio was blowing out against all the other metals, and I was buying it like heck, and I've been buying it at certain areas for a long time. And recency bias, there's people telling me, why would you buy platinum? It hasn't gone up. It's like, Yeah, that's why I'm buying it. Like, I don't understand. I don't. I must not think the same way as other people. I have the ability to hold. I'm extra patient, and I can buy this stuff when it's super cheap. I don't pile all my money into one idea. I've got silver, I've got gold, I've got platinum, I've got other six, seven, eight different sectors that I think have incredibly good opportunities. And then I just sit and I wait. When we get volatility, people start yelling at each other. I mean, if we're going to be in this for the entire bull market if you've bought it from 2020, 2021, you're going to see a lot of volatility in the beginning of these bull markets because you're going to go through a transition of money going away from the dollar denominated assets, which are going to sell off, which could impact commodities and other sectors. Um, and that's part of the cycle. But just because I know that doesn't mean it makes it super easy because you still see your account values go way up and down. So I'm playing this whole move, and for some reason, everybody wants to force me into a trader. I was a trader, guys, and I was really good at trading. But I'll tell you this, I have never made more money by doing nothing, which is far easier and far less stressful, and you make far more money to just buy it when it's super cheap and to not do anything. Now, we had a big pullback here, and I obviously experienced a very large pullback in my account, very large, because I have big positions across commodities and a bunch of different things. And I'm going to tell you this, it's part of the game. If you're going to play the big long term, big picture view, you will experience 30, 40, 50, 60% pullbacks in the companies you are in, depending on what companies you have in the portfolio and what sectors you have. That is normal. Now, some people say, well, that's not a bull market. It is. You're making higher highs and higher lows. And some of the definitions don't meet, that's not a stage 4 decline in the Weinstein. Commodities are just that volatile. And as you go up and you come down, and it cycles up and down, at least in my opinion, a stage 4 is like an end of trend move. And what you're seeing is that the market cycles up and down are just really big, the size of them, which produce big returns. So I mean that's the cycle, and I've been participating in this cycle since 2020. That's exactly the same time that I opened this YouTube channel was August of 2020. The reason I opened it then is because a commodity bull market was coming. I decided and tried to figure out what to name this channel. And I was thinking, something precious metals related or something commodity related. But I was like, you know what? The cycle will change eventually. So I named it Finding Value because the value was in commodities and precious metals. The returns, the big returns are all about sizing the move. And sizing the move, I don't know if a lot of people can do it very well, is what I've learned, is because they're so impatient. Patience is what kills returns. Or sorry, impatience is what kills returns because they chase whatever the shiny object is at the time. Your entry points should be based off of valuations and technicals. It should be both. And when you get an early entry point, sometimes it takes a year or two to get out of that. And then the moves really start to pile on. And then people are even more impatient if you get a big up move and then you get a pullback. So I don't know if it's a function of personality traits. I don't know if it's a function of not understanding the cycle, maybe not understanding the sector. I'm not exactly sure. I can't answer that for other people because I'm sure it's a variety of different things. But I just wanted to throw that out there. Rock Bottom Entry says surging gold and silver prices paired with plummeting oil prices are a bullish 1-2 punch for the mining companies. Profit margins are going to skyrocket, tossed in a failing, or I was going to say falling US dollar, and weakness in tech. And it's obvious precious metals is the trade right now. It could be. Now, here's the problem with trading. Trading, then what people are going to do is they're going to pile all into one sector. And what if you're wrong? What if gold relaxes for a little bit, silver takes off, does a run real quick, and then oil takes off? If you position all your money in one sector, you you basically bought into a potential consolidation. And I'm not saying gold's going to consolidate. I'm just giving an example. You could consolidate while other sectors rip. And then when that starts to slow down, the oil sector, you swap your money into oil and then gold and silver rips because they basically rip in opposite movements. In my opinion, it's better to play the bull market that creates higher highs and higher lows by having an allocation across different sectors. And that's what keeps the portfolio a little bit more stable, a little bit more balanced. And sometimes the portfolio can get unbalanced depending on how much some of the companies go up if you want to hold on to it. And that's where we're going to end it there because that's no. Okay, never mind. The producers are cheap and could see a significant ramp in cash flow as copper prices rise, an under-owned building block for the global economy. And this also is signaling this is not what a recession looks like, guys. This just isn't. And oil follows this. U.S. shale oil production was already getting gassier and rolling over. If WTI falls into the 50s, production will quickly, in 4 to 6 months, fall by 500,000 barrels a day. Over a 1 year period, producers will cut overall U.S. crude oil production down to 12.5 million barrels per day. And that's your supply response to too low of prices. So we could get a dip. I don't know if it could sustain there because too much production will be cut. And in fact, it's going to create a super spike. This is not healthy. You want oil to be like $80 or $90 a barrel steady so we can grow production and keep pace with everything. We want it to be stable. We don't want prices to go down in the 50s and then create some super spike. We want it to be stable where the companies make good money, like $80, $90 a barrel, and it just sits there. This is the gold to silver ratio. Silver is in a position to lead. The ratio points to a multi-month period ahead of outperformance. Yeah, looks good. Peter Sutherland says, deep breath, oil is oversold here. OPEC is not capitulating by adding back 135,000 barrels a month. Market can absorb that increment easily after turnarounds. No one will drill baby drill at this deck. Equity turbulence will force Trump's hand on tariffs and crude. Inventory spreads are fine. Clint Simmons says asymmetric outcomes in place. The probability oil surges to 90 from here is far greater than the probability it crashes to 50. Operational break-evens near assure this. Trump would have to eliminate all E&P taxes to get them drilling at that price point, and that isn't happening. I think it is much, much easier to envision much higher prices from this point forward. This cycle is going to end with prices surprising every expert with unforeseen outcomes. If change is the only constant, then buckle up. Bob Farrell rule number 9. I love it. I love it. I totally agree with that too. We're going way higher out in the future. The end of this bull market is going to be multi-$100 oil. In the short term, we've got to slow down. We're going through an air pocket. Logan says, share of mortgage loans and forbearance decreases to 0.4% in January. So there's no selling pressure from the real estate market. But then you got these boneheads. Don't forget that loans and forbearance are prevalent too. 0.4%. My God. Jesus. Do these people look at any data before making these comments? Vancouver Island guy says, why is $50 oil not realistic? Even 60 is not realistic for any significant amount of time. American break-evens are now $59 to $70 a barrel WTI for Permian. Once you go below this, guys, it's like lighting a fuse and you're just waiting for price to go back up. You're below the cost curve. Last time we had counter-seasonal oil inventory draws like today, back in February of 21, oil went from 64 to 140 over the next year. That's what the inventories are talking about. And I think that's why OPEC is bringing back oil. They don't want that spike. And that's what we've got for today. So we're going to end it there, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. We've got a Sunday question and answer session coming up, 5 p.m. Mountain Time. And that's all I've got for today. So we'll catch you next time. This is Finding Value.